Welcome to S&P Capital IQ's monthly loan market overview. I'm Steve Miller, a member of the Leverage Commentary and Data team. Over the next few minutes, we'll review recent market trends. In preview, the loan market cooled slightly in February in response to more plentiful supply. Still, with demand robust, conditions remained highly charged. Before getting into our usual market analysis, first we note the recent pickup in new issue volume, which doubled during the first 10 weeks of 2013 to $138 billion compared to the same period in 2012. From the standpoint of paper-hungry managers, however, there is less here than meets the eye. All told, refinancings accounted for 70% of activity so far this year, with M&A-driven deal flow a mere 20%. Market conditions softened a touch in February as supply increased. However, demand, as we discuss ahead, remained muscular. Therefore, prices eased just slightly from the post-credit crunch highs of January. The demand picture was mixed in February. Hurt by tightening arbitrage, CLO issuance slipped to $6.5 billion from a 5.5-year high of $9 billion in January. That decline was almost fully offset, however, by inflows into loan mutual funds, which rose to a 2-year high of $5 billion from $2.9 billion, according to EPFR. The net supply of outstanding loans expanded $6.5 billion to a recent high of $557 billion after contracting slightly in January. As a result, the technical surplus of inflows over supply narrowed to $5 billion in February from a whopping $13 billion the prior month. Moreover, Dell and Hines proposed jumbo LBO deals bolstered the all-important forward calendar of M&A-driven loans to a post-Lehman bankruptcy high of $27 billion, allowing accounts to be more selective. Issuers continue to press their technical advantage to structure more than half of new loans as covenant light. With the scale a bit less tilted to demand, new issue clearing yields inched wider in February from January's post-credit crunch lows. Roughly speaking, double B loans printed in a 3.5% context, while single B loans cleared in a 4.5% to 5% range. Likewise, strong repricing activity persisted. Issuers reduced spreads on $41 billion of loans in February, pushing the year-to-date total to $82 billion. On average, the issuers in question have saved 135 basis points on the 2013 class of repricings. Switching gears, the loan market default rate inched down to 1.4% in February and remains well inside the historical average of 3.3%. Managers expect the rate to reach 1.8% or so by December, according to LCD's latest buy-side poll taken in mid-March. In early March, the market heated up again. For one thing, beyond the immediate calendar, participants say that the front-end activity for new LBO deals has waned, suggesting that new issue supply may be headed lower in April. As well, CLO issuance picked up, generating more demand. As a result, LCD's flow name composite, our most real-time indicator of market demand, rallied 21 basis points during the first week of March to a 6-week high of 99.8. Inflows, as mentioned, are encouraging. Retail investors, for instance, in early March put $165 million a day on average to work in loan mutual funds, according to EPFR, up from a daily average of $150 million in February. As well, CLO volume surged to $3 billion during the first week of the month, putting the market on track to test January's recent high. The increase came amid declining liability spreads, which bolstered CLO model returns. Finally, participants remain constructive on the loan market, though all the usual macro concerns persist. That brings us to the end of our overview. For more information on the loan market, you can check in with us on the web or via LinkedIn, Twitter, or Facebook. The links for each is in the description below. You can also download this presentation at slideshare.net.